Welcome to the briefing then for Tuesday the 4th of October 2016. And here we are, pound in focus as we now trade at the lowest level since 1985. Sharing with you my pound chart here, and firstly, we're going to talk through this a little bit more, but great to see all of you guys took advantage of what we're about to talk about with this sell-off in the pound that we've seen this morning. So some really excellent trades there. I know there was a couple of points of entry, and you all got it pretty much right on cue. So well done for that to really kick things off today on a good start. But obviously there was a couple of things we were looking at yesterday, and one was that I think it was the 72 level. That was like the mid-August low. And then we were talking about we failed to really break that convincingly. Then in the afternoon saw a bit of a run lower before bouncing, and then really yesterday's low print was at 28.33, and then you also had the Asia Pac low that was seen at around the same level. So there was a decent line of support here. When I first sat down at around 7 o'clock, we were trading just above it. And we were, I was calling on the mic, just keep an eye on that level. It got tested a couple of times, and when that gave way, really you saw some of the downside momentum take place. You had the initial spike lower, it came back up, a classic opportunity there, and then we went back through, and then added pressure going through the S1, and then 128 psychological, that ran lower again, it came back up to 128, you can see to the tick. Again, another push to the downside. So, Brexit lows have now been officially eradicated. You can see here, that was the low point there that we traded back on the 6th of July at 06. Where do we go from here? First thing, when Piers walked in this morning, calls of 125 circulating in the air. But down here, there's really not a hell of a lot now on the downside. And what I want to do is kind of put this in a bit more of a macro picture for why have we were talking at the end of August, beginning of September about cable at 135. Now here we are, breaching fresh multi-year lows, the lowest in 31 years. If you remember back at that point, we had some good data. It was good economic data and surprisingly strong and consistent what was coming out of the UK. And we were coming up to around the top of that trading range that we had since the aftermath of Brexit, both immediately after and then at the kind of mid-July, came up not quite as high at the beginning of August. But then ever since then, obviously you've had the kind of digestion of the fact that the Bank of England have committed to doing more easing in the future. Data has remained solid, but obviously we're getting closer, and the real catalyst more recently has been closer in toward triggering of Article 50, which is ultimately the key. Despite the fact that the FTSE is trading at its highest level since summer of 2015, the politicians who were calling, I remember at the time after Brexit, they were going, look at the FTSE, look at the FTSE. Well, that's fine. The FTSE is above 7,000, the highest since June 2015. But again, this is all supported by sterling's weakness. Don't forget, the FTSE 100 index is full of international companies. It's not like the 250 or the FTSE AIM, which are more domestically based, focused in the UK. These are international blue chip companies which benefit from stronger foreign revenues as the pound depreciates. And so to look at the FTSE alone is a bit of a false economy. Also as well, what I've been talking about with the pound is that a lot of the economic data we've been seeing, even with the manufacturing print which we had yesterday in the UK, the underlying, you scratch beneath the headline figure, and that also was boosted by foreign demand due to the lower pound. Golden Week holidays, Oxford Street predicted to be booming as Chinese foreigners come in and spend money on luxury goods to take advantage of the lower pound. So these kind of inflated UK economic data points, I think, are don't reflect truly the underlying state of the economy, which I think, for one, is not as healthy as is suggested by recent data points. And the biggest thing, then, obviously, Theresa May at the weekend being fairly hard line in terms of the stance, followed up by Hammond, who said the UK will face at least 2 years of economic turbulence along with a period of fiscal uncertainty. He also added that business confidence would likely go on a bit of a roller coaster as the process gets underway. It's exactly what I want to hear to settle my nerves, is the Chancellor seemingly, telling it how it is really, but quite a worrying assessment of the future going forward for the UK economy, and not forgetting this is just the beginning of the process. We're not actually going to trigger Article 50 until the end of March and around that timeline. So between now and then, hard to see the situation, if anything, improving, because the negotiation process hasn't even yet begun. The other thing not to forget here, though, and there's a couple of charts I want to show you, because the reason why cable has come down quite aggressively from 130 more recently, all the way down to now sub 128 handle, is not just about the pound. Obviously the pound is weak, but don't forget about the dollar. The dollar index this morning up around 0.5%, back above 96. Granted, a lot of this is to do with the pound weakness just lifting the dollar index itself, but check out the dollar over a 5-day performance. The dollar versus the yen, it's a 5-day dollar advance that we've had. So if you think about it, we had the small and expected increase in US payrolls for August, muddies the Fed outlook. But since then, I think I wrote a list this morning, you've had ISM manufacturing stronger than expected, durables better than expected in the US, consumer confidence the highest since the initial financial crisis, Q2 final GDP has been revised up in the US. So you've got it's really a dual negative forces weighing on cable. You've got a re-strengthening dollar on the back of what has been improved economic data from the States ever since they decided to hold rates and sound dovish on their projections, in combination with a more pessimistic assessment of the UK outlook going forward amid a hard Brexit. Part of this further fueling of dollar strength, Fed's Mester spoke overnight. Now, she is a voting FOMC member and a leaning hawk, but continues to push the point. Mester said the economy is ripe for an interest rate increase, repeated the Fed's November meeting should be viewed as live for a policy decision despite its proximity to the US presidential election. So, people have been widely, the consensus is that the Fed will swerve November, given the close proximity only being days between the US presidential election and the Fed decision, and that December is more viable. But Mester, granted, probably the most hawkish, saying that November is live and should be viewed that way. Slightly showing, though, the divergence of the Dove-Hawk scale. Just to give you a fair assessment, Fed's Dudley has also spoken overnight. I'd imagine these two don't get on very well when they have dinner in the evenings after their Fed meetings, as Dudley says advises caution in raising interest rates, suggesting the central bank should be cautious, given limits on its ability to respond to a recession with borrowing costs close to zero. So not exactly a slam dunk in terms of all of the members lining up in the same direction, but certainly from economic data points of view, which is why as well the fate of this pound could also come down to some of the economic data points from an employment perspective in the US this week. Don't forget, you've got US ADP. That will then line us up nicely for US non-farm payrolls on Friday. And if we get another 250,000 type print in the context of a weak backdrop for the pound from a UK perspective, then certainly this the British pound could come under some further selling pressure. Looking at the Fed Watch tracker, you can see here December probabilities have been on the increase. This is the CME Fed Funds Futures they're tracking at around 56% baked in now for a interest rate hike in December. The Bloomberg reading's tracking a little higher, actually around 60%. So at this point, December is priced in for a 25 basis point hike from the Fed. That means then, as we've been seeing with US economic data of late, the way that you should look at that in terms of price movement is we have moved back to this theoretical norm that good data means that if we hike, the economy is strong, so equities up on good data rather than the monetary policy play that we've seen of a few weeks ago. So I'd be expecting that to play through in terms of the coming days. Not too much really on the data slate from the US today, but obviously ADP are focused on Wednesday and then non-farms on Friday, so probably a similar type theme. So good data just means strong economy, which means higher equities, lower T-notes, stronger dollar. The kind of more classical play. A quick look elsewhere though, let's just quickly go back to the charts because it's worth looking at the equities again, because we have seen a move to the upside already. The DAX, don't forget, they are returning in Germany from a market closure for Unification Day yesterday. And positive for those markets is Deutsche Bank. Check out Deutsche Bank shares here on this graph. That was Friday afternoon. Remember you had those comments late afternoon about the litigation fee said to be more, circa 5 billion euros, much smaller than the 14 billion that was touted a few days before, that really sparked the speculation about their capital situation. Their shares have rocketed really ever since to the upside, and we're up 2% or more at the moment in terms of returning to trade for the first time this week. It's almost if this sterling break, this kind of now overarching focus that the pound will get, given this historical low it's now trading, has been beneficial for Deutsche Bank because the market focus has been moved to somewhere else rather than targeting Deutsche. So it looks like, thanks to the pound, Deutsche may have just been able to avert some of the attention. The bank holiday, I guess, couldn't have been any more better timed for them. And their shares up this morning, and that's relevant because of the market sentiment as it was driving things from a macro point of view last week to a strong degree. So it's definitely worth keeping an eye on them, but certainly this morning they seem positive. You can see the Eurostoxx DAX on the front foot. That's helped lift the S&P future as well, which was in a very tight range overnight. Don't forget the tight range in S&P and SPOOs overnight, probably due to the fact that Asian markets fairly tame. Chinese markets are closed all week for Golden Week. And another footnote on the holiday front, don't forget it's still the Jewish New Year holiday today as well. So as you saw yesterday, volumes were lower. Would be expecting that to remain the case for the US session. Quick flick back though to the calendar for today. Pretty quiet overall. You've had the RBA overnight, no real shocks there to speak of, even though you've got a new governor that's in place. But UK-wise, do keep an eye on the construction PMI. Obviously, given the fact now we're at these new depressed levels, any further weakness seen in these PMI numbers, don't forget it's the PMI week. So you've had the manufacturing from the UK, construction today, you'll get the services, which is the most important one for the UK, given it comprises around 3/4 of the kind of makeup of our economy in terms of being heavily geared to the service sector. But the construction one will be closely followed for the pound, so keep an eye on that at 9:30. This afternoon, though, very little of major importance for the US. From a data point of view, you've got the IDB tips, but that's really, I'd say, third tier really on the importance level. The API crude oil inventories, as per usual, they'll be coming out after NYMEX pick close. Couple of speakers, though, to keep an eye on. ECB's Pratt speaking at 11:50. Fed's Lacker, a non-voter, leaning hawk, would be expecting similar type comments probably to Mester. Bank of England Saunders, though, could be an interesting one for any pound traders, because Saunders is the newly appointed MPC member, and as you can see denoted by let me just flick over to this calendar. Saunders has no stance at this point. That's because we're yet to really have heard an outright speech from Saunders to really gauge views on the economy. So this is one of the first insights we'll get into his thinking. So that'll be a key one at 4 o'clock. Otherwise, that pretty much wraps up the briefing for this morning. I don't want to stay on the mic too much because ultimately it's all about one thing, and that is the pound, this fresh move to the downside, post-Brexit lowest since 1985. The FTSE, though, up multi-month highs, just further buoyed by the fact of this weaker pound. Okay, guys, I'll catch you in the chat room. Any questions, please fire them my way. And enjoy your day. And for those who traded the moves this morning live, guys, very well done.